On February 10th, Google issued a 100-year bond to fund its artificial intelligence ambitions. A bond that won't mature until the year 2126. A handful of people alive today will see it paid off. And Google is not alone. Morgan Stanley estimates hyperscalers, the mega platforms powering the cloud and AI infrastructure, may need to borrow as much as $400 billion this year alone. That's almost equivalent to the entire GDP of Hong Kong. In this video, you will understand what's driving these radical decisions and their implications for the American economy, the artificial intelligence landscape that defines our future, and for real Americans. The scale of commitment from the technology sector in 2026 is, by any historical measure, extraordinary. Tech giants like Microsoft, Meta, Google, Amazon, and Oracle all together project around $650 billion in capital expenditure for this year alone. Just so you see the dimension of the operation, their bet is as big as Sweden's entire GDP. Google alone raised its forecast to $180 billion, an increase of more than 40% from prior plans. Amazon plans to spend $200 billion, as reported in industry updates. And to fund part of that ambition, Google's mid-February bond issuance raised $32 billion in just 2 days, all of it directed toward AI infrastructure. Yet the market's reaction has been quite telling. Google's stock fell over 2% recently. Microsoft and Amazon also declined from their February peaks. Investors, it appears, are doing the math, calculating whether revenues can actually justify these endless capital outlays, especially when meaningful returns remain distant and uncertain. That tension between historic ambition and financial reality sits at the center of everything we're about to examine. To understand where we are, it helps to walk through what's actually happened in recent weeks, because the events have come fast. In late January 2026, Anthropic CEO Dario Amodei published an article warning of what he called AI's adolescence, urging a direct confrontation with the risks posed by overly potent systems that could, if mishandled, escape human control, per the piece itself. It was a sober warning from someone building the very technology he was cautioning about. Then came early February, and market shocks that got Wall Street's attention. On February 3rd, the Wall Street Journal reported that emerging AI tools had erased $300 billion in market value from software and data firms. By February 9th and 10th, the disruption had spread to financial services. Firms like Blackstone and Apollo saw their stocks decline as AI encroaches on contract analysis and advisory roles, work that has historically required highly paid human professionals. A February 11th Wall Street Journal article captured the moment plainly, describing how these AI models are, quote, revolutionizing and shaking markets. Meanwhile, tools like OpenClaw raised serious privacy alarms by automating daily tasks directly on personal devices. And separately, a forum on what's been called MeBot, or Reddit AI agents, revealed something genuinely unsettling: humans posing as bots. With AI agents reportedly developing private languages to exclude human participants, a development that, as observers noted, alarms anyone paying attention to questions of uncontrolled AI evolution. If you're liking this content so far, like our video, turn on the notification bell and subscribe. Every week, we're posting several analyses about what's happening in the world. Still, no examination of the AI landscape in early 2026 would be complete without addressing Elon Musk. On February 3rd, Musk's private company SpaceX acquired xAI, the parent of X, formerly Twitter, and the Grok algorithms for $1.25 trillion, valuing X itself at $250 billion. The transaction benefited the remaining X employees, but it also sparked considerable speculation in financial circles about whether this constituted a quiet rescue operation, given that xAI reportedly generates hundreds of millions in monthly revenue, yet is speculated to be running billion-dollar losses, though that remains unconfirmed. Musk has not directly denied the rescue narrative. Critics drew comparisons to Tesla's 2016 acquisition of SolarCity, a deal that involved one of Musk's cousins as a key stakeholder and which has not thrived within Tesla since. Whether history rhymes here remains an open question, and Musk's stated ambitions have shifted as well. He has described his priority now as, quote, assuring the future of civilization, and on the moon it's faster. A pivot from Mars colonization toward lunar cities within under 10 years. He does affirm that Mars efforts resume in 5 to 7 years, but observers are asking, does this represent vision or mission drift? OpenAI, the company behind ChatGPT and arguably the most recognized name in consumer AI, is also navigating significant turbulence. NVIDIA walked back a 2025 pledge of up to $100 billion in support, clarifying that investments would be, per recent updates, phased over time. Meanwhile, OpenAI itself signals it will need $1.5 trillion over coming years, relying on continued user growth and debt financing to get there. This comes amid swirling IPO speculation across the sector. SpaceX is reportedly valued at $1.5 trillion, roughly equivalent to 25% of the US entire federal budget. OpenAI at $800 billion, equivalent to Poland's GDP, Anthropic at $350 billion, on par with Thailand's GDP. These are staggering numbers, but as of now, questions about their long-term viability linger without clear answers. For the average American, this massive spending raises practical questions beyond stock charts. If AI delivers promised productivity gains, according to reports like those from LPL Financial and the St. Louis Fed, where AI-related investments already contributed significantly to 2025 GDP growth, it could lower costs in healthcare, administration, and services through automation of routine tasks like paperwork or scheduling, potentially boosting real incomes even if nominal wages lag, according to PIMCO analysis. Data center builds have created thousands of high-skilled jobs in some regions, supporting local economies, according to Capital Analytics Associates. Yet, conditional on slower monetization or uneven adoption, risks emerge. Executives like Anthropic's Dario Amodei have warned AI could wipe out half of all entry-level white-collar jobs in 1 to 5 years, per his 2025 statements echoed in recent coverage. Broader estimates suggest AI might automate tasks equivalent to millions of jobs by 2026 to 2030. For example, Goldman Sachs on 300 million globally, World Economic Forum on 85 million by 2026, particularly in retail, manufacturing, and office roles. Mustafa Suleyman, Microsoft's AI CEO, has echoed the intentions of the AI industry to provoke a massive wipeout in the job market. Take a look.
I think that we're going to have a human-level performance on most, if not all, professional tasks. So white-collar work where you're sitting down at a computer, either being, a lawyer or an accountant or a project manager or a marketing person. Most of those tasks will be fully automated by an AI within the next 12 to 18 months.
Power demands from data centers could indirectly raise utility costs or divert resources, according to some analyses by the Washington Post. For most Americans, questions that should be raised are, will this lead to cheaper/better tools and services, or job instability and slower wage growth? So what do we make of all this? Let's examine the deeper tensions these developments expose. Big tech has historically operated as an asset-light business, generating enormous cash with relatively modest physical infrastructure. That model is changing dramatically. Google generated $164 billion in operational cash last year on $130 billion in revenue. For a company with Google's balance sheet, that may be manageable. For less financially robust players, the strain could be severe. And here's a historical parallel worth sitting with. According to investor Michael Burry, Google's 100-year bond echoes Motorola's 1997 Century bond issuance. That year, Motorola ranked among the top 25 companies by both market cap and revenue. Today, Motorola sits at number 232 with $11 billion in revenue. Why pursue century-long debt right now? It signals urgency. But if returns falter, could it foreshadow a similar trajectory? Then there's the disruption question. If AI is genuinely automating legal, financial, and software tasks, as the market data from February suggests, why have investors punished the very sectors being disrupted? Managers insist the fears are overblown. Yet uncertainty is clearly driving the pullback. Markets are sending a signal. What exactly that signal means is still being debated. The analysis you just heard is a collaboration with Fernando Ulrich, a prominent Brazilian economist, Bitcoin pioneer, and financial educator. He's the author of Brazil's first Portuguese book on Bitcoin and a leading voice in Austrian economics, macro analysis, and sound money advocacy. Let us know in the comments what you think about this power move from big tech companies. If you like this video, like and subscribe to get more explainers like this. Every week, we're dropping 10-minute briefs that can help you understand better what is happening in the world. So turn on the notification bell to get them as soon as we drop them. AI is gaining momentum, thanks to big tech funneling billions to it. Yet the risks can overflow toward basic liberties, like OpenClaw. However, it is not the only case. There is a great network of tech companies and government agencies that enforce an official discourse that citizens must follow through and through. It works like a censorship complex and has tentacles all over America and abroad. We study this problem in God Complex, The Rise of America's Censorship Machine. You can learn everything about how technology can shape or shut down your freedom. You just need to register in the link below or read this QR code and you'll receive a free ebook with exclusive content.